Good evening, everyone. My name is Stefan Mauch, and today I'm presenting my final project for our course Introduction to GPU Programming. My project title is GPU Accelerated Portfolio Optimization for Multi-Asset Allocation using CUDA. And I really hope you enjoy it a lot. So here is the result I want you to remember from this entire talk. So by moving portfolio optimization from a standard CPU to an NVIDIA GPU, I achieved roughly 15.3 times end-to-end speed up at 1,000 assets. And yeah, this is a headline number. And by the end of this presentation, you will understand exactly where it comes from. And the two CUDA libraries that makes this possible are cuBLAS, which handles all the matrix math, and cuSOLVER, which solves the linear systems at the heart of the optimization. And everything runs on a NVIDIA Tesla T4 GPU. And this is what I used in Google Colab. And yeah, the key practical insight is, especially for as large portfolio sizes, GPU acceleration stops being a nice to have and becomes really a necessity. And this brings me to the next slide. So portfolio managers today are basically dealing with the universes of hundreds of thousands or even millions of thousands of assets, even larger millions of clients' portfolios. Depending on the assets under management, a given portfolio manager or asset management firm does have, and they need to rebalance faster than ever, sometimes intraday, sometimes even 1,000 times per day, even more. And they use multiple techniques doing that. They do Monte Carlo simulations, they do portfolio optimization given constraints, so they need to bring down their portfolio weights back to custom target, for example. There are client actions and many more restrictions given the complexity or depending on the complexity of portfolio management operations. And the two main cost drivers in these pipelines are covariance estimation, typically, which, as you can see here, scales as order t times n squared. And that depends on the number of trading days and the number of assets in the portfolio. And I've used Cholesky factorization, which scales as order n cubed. So in other words, when we double the number of assets, your runtime roughly quadruples for covariance and octuples for the solve. So the runtime not only so there are different components in this project. So first of all, we measure, or I try to compare, or I show you how I've compared it. We compare the total running time in general for running multiple parts of the code and also individual components. So depending on the optimization problem, so we have in this times we're minimizing risk, so the covariance, and then the solve itself. So really depending on the individual components of the code. So we're running multiples, and I try to make it a bit more visual for you to show you some nice output so that it's also practical. And eventually you find the output more interesting than the code. So we can talk about it and let's have a nice discussion as well. So just back to this slide here. So to make this concrete, so the fundament or price data I've used to simulate and backtest those portfolios were roughly 10 years. So a year has roughly 252 trading days, meaning we have a history of roughly, let's say, 2,000 days. And in my simulations, I've used up to 1,000 assets and buckets, increasing from 25 assets. And the covariance computation alone requires, or yeah, in this case, just multiply and you would have roughly 2 billion floating point operations here. Yeah? And on a CPU that already takes nearly 5 seconds per solve. I will show you all the results later. And then, yeah, when you run that once a day for a year, let's say, just for these kind of simple operations, with 1,000 bootstrap samples, you're looking for, or at over 5 days of CPU compute time, and we're not talking about a super, very high-end complex problem to solve here. Um, and yeah, that's a problem. I think GPUs solve it by executing those massive operations that scale in parallel. So from what we've learned in the class, so different parallelism techniques and buffering techniques across thousands of those, and trying to bring that workload down to save computation time. And that's why that matters. And I try to make it as practical as possible, and I really hope you like the project a little. Already curious to get your feedback. And yeah, this is um, yeah, for demo reasons, this is the live or the full pipeline execution, running the script. And in summary, just to make it very simple before I dive deeper into the code base, it compiles the CUDA source code first, downloads real price data, in this case ETF price data across different multiple asset classes. So we're talking about fixed income, equity, international versus domestic, fixed income, real assets, commodities, and others. But I will have another slide prepared for you, and then run both the CPU solver and the GPU solver on exactly the same inputs, generating all the benchmark figures, exporting the tables, etc., and coming up with some nice visuals as well. And on the way, when executing those multiple components, we can compare those steps in real time. And yeah, and identical is, I think, critical. So identical data, identical math, just different hardware backends. And yeah, that's why, that's why let's, okay, no, just before deviating from here, but what do you see in this case, when comparing the performance of those systems? We see we have a break-even performance when reaching 250 assets. So this is where CPU and GPU performance is quite similar. You will see some differences, solve versus covariance and total running time, etc. So this is gonna change. And just for compute reasons, I also provide you with some nice portfolio matrices to see how risk efficient our portfolios are, including Monte Carlo, etc., etc. And yeah, so this is the agenda of the day, or for this presentation. This is a little roadmap I would like to provide you with. So there are more or less five, yeah, I think five overall. Sorry, there are five broader section in general, five sections in general. So we have the financial model and the global minimum variance computations. We have the systems architecture and the GPU pipeline, and the data set and the hardware setup. And so I will show you some speed up curves, runtime GPU versus CPU, the target or final portfolio weights in the end, and also a frontier and the backtesting results. Yes, so this is our financial model. So let me introduce you to the global minimum variance portfolio. It's pretty simple to find a set of weights across all assets that minimizes total portfolio risk. And in this case, it's variance, without making any assumptions about expected returns. And in this case, as you see from the objective function, it's purely about minimizing risk under certain constraints. And in practice, there could be many more constraints, but this is very simple. So we have a size constraint in this case of one, meaning all the asset, all the net weights of the portfolio need to sum up to one. There is no short sale constraint, meaning in this case we can short and go long positions, or we can buy and sell positions. And across asset classes, the only thing is they need a net weight of 1 in the end. So everything needs to sum up. And this is, for me, it's super interesting since we can also see within an asset class what ticker, meaning what security we should sell or should buy given market circumstances. And yeah, just back to the math, it's pretty simple. So we have the financial price data of the ETFs. And when I remember correctly, we have 44 ETFs representing different sectors, and we calculate the returns, and from those returns, we calculate the variances to get the final portfolio volatility in the end. And yeah, another critical design decision is never invert the covariance matrix directly. Instead, or in this, I've chosen Cholesky factorization because it decomposes a symmetric positive definite matrix and just transposes it back. So this is a bit this is more computational efficient and more stable from my research. And on the GPU, this pipeline maps cleanly to three CUDA libraries. So we do the column compute via cuBLAS Dgemm. So this is BLAS level 2. The covariance estimate, that's BLAS level 3, and the solve performed let me think about, via cuSOLVER DND something to factorize. I don't remember. Yeah, so for those, we have the CUDA libraries, but I will execute the script in a live demo and will explain a bit deeper. And this is a small ridge regularization here as well, for the diagonal elements of the covariance matrix. And the next slide shows you the system architecture, which is split across 7 source files. And this is what makes a CPU versus GPU comparison, I think, straightforward. The data loader reads and pre-processes these ETF price data into reading matrices, as explained before. So we pull them from EU Finance and go back, in this case, roughly 10 years, but we could do it longer. But I thought 8 years is a nice time frame, where it may have a real portfolio implication for today even. And both solvers get their input from a single source, so I think it's good to rely on only adjusted closing prices from Yahoo Finance. So there's nothing we need to adjust in the price data to make them comparable, so it's pretty stable, and there's not a lot of pre-processing, so it's very straightforward. The CPU portfolio implements the Global Minimum Variance pipeline. So column centering, covariances, Cholesky factorization, forward and backward substitution, etc. And yeah, that's a baseline for these portfolio optimization techniques. And then we have the GPU portfolio that mirrors CPU solver by calling cuBLAS and cuSOLVER. Same math as said before, different hardware. Then the benchmark calculates speedup times, compares them against each other, and calculating overall overheads. And then last but not least, the synthetic benchmark.cu generates, so for Monte Carlo, all these random return matrices and tries to reduce some network noise as well. And so this is basically the backbone, and the key principle, yeah, is pretty clear. Yeah, we have, um, yeah. So this is just for comparing the runtimes, and yeah. So now let's talk about the exciting stuff. Um, so since it's about multi-asset class portfolios, meaning multiple asset classes within one portfolio, um, I've decided the data set to include 44 ETFs, so meaning exchange traded funds spanning around across 8 asset classes. Um, so we have US equity, international equity, fixed income, real assets, commodities, factor ETFs, and international fixed income. So in US broad equity, we have the S&P 500, tracking the 500 largest US companies, along with the QQQ, which tracks the Nasdaq 100 technology index, the Russell 2000, tracking the small cap index as well, so including small cap companies, the Dow Jones, more on the industrial side, and then also the total US stocks covered by the other one, the last one. For US sector equity, we have 9 sector ETFs. So we have different sectors covering most of what's being classified as sectors by the global industry classification standards. So meaning we have technology, we're covering financials, energy, healthcare, consumer staples, etc. In international equity, so the most important here is EFA, covers most of developed markets outside US. And also we have, let me double check here. We have, yeah, so so most of it, so it's a fair balance between emerging and developed markets with and without USA. To summarize it up a little. In fixed income, we have a good balance between long duration, mid duration, short duration, between treasuries and other fixed income bonds in the investment grade and high yield category. So we're separating by issuer quality, by rating as well. So we have a very diversified asset base here. In real assets, yeah, we have. And so in real assets and commodities, we have gold, silver, we have real estate, we have real estate investment trusts, we have, what did I say? Gold, silver, we have crude oil. And so we have most of the assets you can get and buy on the market. So we have a fair representation of assets available. So I think this is a very investable benchmark. And I think this is a good foundation for constructing a multi-asset portfolio for a retail investor. And this this diversification matters because Global Minimum Variance Optimizer is entirely driven by covariance, by the covariances and the correlation, the underlying correlations. And so the underlying fundamentals of each is different. So on the next slide, sorry, I think it's okay, it's coming later, but I also provide you with some correlation matrices. So what the optimizer does is over allocates to less volatile assets and under allocates to more risky assets that are characterized by higher volatility in general. And yeah, so on the next chart, so a little insight into my research. So look at the two curves. So the CPU line climbs steeply as the number of assets grow. So we have the multiple buckets. So in this case, 6 buckets. We start with the 25 assets and then in incremental steps up to 1,000. And the GPU is actually slower than the CPU for small number of assets, which is expected. And then the GPU has more or less a kind of fixed overhead. So there's a little bump on the right side, but yeah, when allocating GPU memory with the CUDA malloc, transferring data across the what was it? Yeah, so when, okay, okay, what we can see is we have basically a break even between CPU and GPU with a number of assets of 250. So before the CPU is faster, after that the GPU is faster, so the runtime explodes for CPU Cholesky. So yeah, but I provide the numbers on the next slides. So and here it's just breaking down by operation, so covariance versus solve. And you see here even the number of assets is smaller, 100. So it depends on the operation we do. So the break even, we achieve the break even much earlier with a smaller number of assets here. So number of assets roughly 100. Here is 250. So depending on the complexity of the operation as well. And then just some, yeah, the speed up curve. So that I think the speed up curve makes it easier to see. So you see only one line, and we divide CPU time divided by GPU time, and everything above 1 means the GPU wins, and everything below the CPU wins. And this is what I explained before. So below a number of 250 assets, the speed up is less than 1, meaning GPU is slower. Everything above the GPU is faster, and in between there's a break-even point. And let me check the exact number. I think the exact number was a bit slower, like 248. Yeah, and I think this is practical. This is a very practical engineering decision, because if a portfolio manager has fewer than roughly 250 assets, imagine a few clients and then large assets under management, then they use CPU. If it's larger than that, they use GPU. So for a small asset manager, they don't need the computational power. And for a big asset manager, or for one of the bigger ones in the world, and I don't name any, but then they use external GPU like NVIDIA, etc., etc. And yeah, I think in production, the cuBLAS and cuSOLVER handles that very well. And here just facts and figures, just the numbers, the underlying numbers. So here you can clearly see we have the break even roughly, so the close to 1, the speed up close to 1, so break even of 250. And then when we break it down by covariance and solve, we have a speed up here with 100 assets, and here a little later. So it really depends on the operation. So the linear solve achieves in this case roughly 31 times speed up, and that is cuSOLVER's Cholesky's factorization versus CPU Cholesky in this case. Yeah, and this is where parallelism, no, sorry, parallelism, GPU parallelism, and what we learned in class is very helpful. And yeah, the end-to-end execution, I think I mentioned that on slide 1, is 15 times faster on CPU, on GPU with a number of assets of thousands. So when we run everything, then doesn't matter what other parts, but by total running time alone, we are 15 times faster roughly. And this is really a big achievement. And for a small project, this is still meaningful. And so here, yeah, just same data basically. Yeah, GPU, also even on a log scale, GPU hardware executes much faster than CPU, especially at higher bandwidth memory and on accuracy. The difference in portfolio weights. So on the right side, figure 8, it shows the end result. It doesn't show the execution time. It just shows the end result. The end result in terms of tracking error is the same. So we achieve the same results in the end, but it just takes longer. It just takes longer. But the tracking error is the same. Portfolio weights are the same. So we get the same end results, but just a bit faster with GPU for higher assets. And yeah, results are identical, and both approaches work. It's just a matter of speed. So this is where it gets interesting. So this is the actual allocation of the optimizer across the ETF universe, across asset classes in the multi-asset context. And here the optimizer allocates heavily to SHJ, no, sorry, to the iShares Treasury Bond ETF. So this is short duration bucket fixed income, so risk averse asset class with historical low volatility given underlying risk. So equity is more volatile than fixed income. So SHY tracks short duration US government bonds, and let me check. Yeah, the historical correlation, historical volatility was around 1.68%. So the optimizer allocates to low volatility and tries to short high volatility since it's a risk averse approach. So over allocating or heavily allocating to low volatility assets in the universe. We have other holdings like iShares Core International Aggregate Bond ETF, which is the second bar here. Yeah, TIP. Let me check. Yes. And what's interesting also, I mean, in general, you see we over allocating to fixed income. The majority of the total assets are in fixed income, followed by equity and commodity based on their historical volatility. So on a total aggregated asset class level, we see, okay, over allocate to fixed income, a little to commodity, and some moderate allocation also to equity with a 7.6%. And now we can break it down by sectors as well, like on the right chart, and by individual ticker. There are also short positions. There are also short positions like long duration fixed income, like LQD and IEF. Also other equity stocks not stocks, ETFs in the portfolio. For example, emerging market, i.e. EFA, you see EFA negative. No, sorry, slightly positive. But yeah, definitely developing markets, underweight them, sell them, etc. So it has practical implications. I found that pretty interesting. So, and it may be relevant. It may be relevant in the current market environment. Who never knows? Who never knows? And so, yeah, just what I told you before about so since it's so the objective function was to minimize portfolio volatility. The correlation is important to consider. So it's just the covariance scaled by the individual standard deviations. for these 44 ETFs. So here you see the pairwise Pearson correlations. And so we see some positive correlations, we see some negative correlations, and for a diversified portfolio, we want low correlations amongst asset classes. So everything that is not dark red or dark blue or in combination could be interesting to look at. So let me check again. So the fixed income block, for example, give me a second. Yeah, shows low to mild negative correlations with equity. Long duration treasury has a negative correlation with the S&P 500, for example. And this is a good diversification benefit. So bonds tend to rise when equities fall, when providing a real risk benefit. Let's take a look at commodities. So commodities and real assets. Yeah, sorry, I have it ranked by tickers here. But yeah, so commodities and real assets. So for example, gold, GLD, or silver, SLV, sit in between. So you see, yeah. So you see, so we see near zero correlations with equity and bonds. So this is also, that's why we are over allocating or allocating in general to those three, because the optimizer could say, okay, just hold cash, but there are some tickers in the asset class provided that are a good equivalent to cash. And this gives the optimizer some additional hedging opportunities as well in practice. Um, Here on slide 14, this is the efficient frontier. So we can see how risk efficient our portfolio is. So since in the backtesting, and I will show you the live code, in the backtesting, we compare also the performance of backtesting metrics from the global minimum variance portfolio versus maximum Sharpe ratio and equal weighted portfolio, and then just a buy and hold on the S&P 500. And it's nothing else than analyzed volatility on the x-axis and analyzed return on the y-axis, and then scale it. And typically, the GMV portfolio sits at the leftmost point of the frontier, and the absolute, so this is the absolute minimum variance point. And then we have those 50,000 Monte Carlo long-only portfolios simulated, and to see if our results from those backtesting results, if our portfolio is actually in good shape and risk efficient. And here the GMV portfolio achieves 1.62% volatility, Sharpe ratio of 1.36. Everything above 1 is risk efficient, since we get extra return for no additional risk. And yeah, this is a nice output as well. So as I said, we're comparing performance of portfolios, and you see that a buy and hold portfolio on the S&P 500 would have outperformed the equally weighted portfolio and the GMV. However, the drawdown, so the risk constellation or the risk in general during drawdown periods were less, as you see in the lower drawdown graph. So the GMV had the lowest drawdown in general, only of 24.9% in the maximum drawdown. The S&P had almost 34% in March 2020 during COVID sell-off. And in normal years, GMV does underperform the S&P on total return, because as you know, we had a bull market in the equity market. So buy and hold would have been overall the long-term better returns long term. So just a little insight from the output as well. And yeah, so back to the conclusions before we go back to the code. Yeah, CPU pipelines can be very slow, especially at institutional scale for portfolio optimizations at high frequency. So as I mentioned in the beginning, a big asset manager optimizing portfolio, millions of portfolios on a daily basis, and it's definitely good to have a GPU that is scalable. And just back to the insights, the GPU had break even at roughly 240 assets and 100 under covariance computation. So depending on the number of assets, and in the end, I was able to scale up or run the code 15 times faster on GPU than CPU. That was pretty cool. And I think, yeah, and I just wanted to make it a bit more interactive to come up with some nice insights that may be practical. And yeah, GPU, I think, is standard nowadays for bigger problems, and was able to do that with cuBLAS and cuSOLVER. And so thank you very much for listening. And one thing we have left to go through, you can find my source code on GitHub as well. So when you click on that link, you will be redirected to my source code. So you can pull that from, so this is a public, oops, this is a public repository. So you just clone it from here, you run the bash script, and then you get all the output you see here as well. And so let's just run the code now and let's see what's happening. Alrighty. So this is the code structure. So this is a financial price data. These are the output figures. This is all the CUDA code for um, this is all the CUDA code for executing all the benchmark performances, etc. So I also provide you with a Jupyter notebook. That is an option just so you have the option to track everything um, and see the output in the notebook directly. But yeah, it's fully operational and automated. So yeah, you can run in your terminal in Colab or wherever you can run the bash script. And then here in this case, okay, Tesla T4. Okay, I used my memory a little today, so not much left. So this is the environment, CUDA libraries, cuBLAS, cuSOLVER, setting up the directory. All the source codes we need are in it. So this is the structure. These are all the files needed. So especially the GPU portfolio, it's important to boost performance. In the next step, we pull the financial data from Yahoo Finance by asset class. So these are the ticker by asset class. This is the time period. And this is the full analytics pipeline. So you see the runtimes compared to each other, the total runtime, then by compute, covariance, GPU versus GPU. So you see the speed up for each step and for each number of asset classes. The break even is the same for the total runtime, 250. So you can track those in the terminal window as well. And then depending on here, a break even is much worse for CPU. And yeah, so this is the overall structure. And yeah, you can run also the provided Jupyter notebook if you like. So this is just an option. And you have everything provided in here as well, or you just download the folders from from the GitHub as well. All right. I hope you enjoyed my presentation. Looking forward to your feedback, and thank you very much for your attention.